September 17th, 2019. Wall Street is celebrating record highs. The president is boasting about a booming economy. Yet overnight, the core mechanism pumping $1 trillion through the financial system nearly flatlines. Bank reserves have quietly plunged from $2.8 trillion to just $1.34 trillion. A routine $120 billion cash drain triggers market chaos. The Federal Reserve has to choose, intervene, or watch Wall Street seize up, months before anyone had heard of COVID. What invisible fault line nearly caused the system to fail, and why did almost no one notice? Every night on Wall Street, $1 trillion quietly changes hands before dawn. This is the repo market, short for repurchase agreement, a kind of overnight loan that keeps the entire financial system running. Here is how it works. One bank needs cash, another has extra. The borrower transfers treasury bonds or other top-tier securities as collateral, and in exchange, they get cash with a promise to buy the bonds back the next morning, plus a tiny bit of interest. It is simple, fast, and under normal conditions, almost risk-free. But the real power of repo is not in the deals themselves. It is in the scale. Every single business day, more than $1 trillion of these loans flow through the system. That money pays for everything from new stock trades to the day-to-day operations of major corporations. If the repo market freezes, payrolls cannot be met, trades do not settle, and even government debt auctions can stumble. Think of it as the plumbing beneath a city, invisible when it works, catastrophic when it clogs. The entire system depends on trust. Trust that cash will always be available, that collateral will always be honored, and that tomorrow the market will open as usual. But when even a small shortage hits, the effects ripple out instantly. Overnight rates can leap, banks can refuse to lend, and suddenly the basic machinery of finance grinds to a halt. In September 2019, that is exactly what happened, and almost nobody outside the system saw it coming. September 16th, 2019, two ordinary calendar events collided. Quarterly corporate tax payments and a scheduled treasury bond settlement together drained nearly $120 billion in cash from the banking system in just 2 days. Over $100 billion left commercial banks as corporations wired tax payments to the U.S. Treasury. That same day, $54 billion in newly issued treasury bonds settled, forcing Wall Street dealers to come up with fresh cash to pay for their purchases. Normally, these flows would barely register. In the years after 2008, banks held mountains of reserves. At one point, nearly $2.8 trillion sat idle at the Federal Reserve. But by September 2019, that cushion had been whittled down to $1.34 trillion, the lowest level in 7 years. The system was running lean, and every dollar mattered. As the cash drained out, the margin for error disappeared. Banks and dealers watched their reserve balances drop overnight. For the first time since the financial crisis, there was no slack, no extra cash to soak up a sudden demand. The entire machinery of Wall Street was now balanced on a much thinner buffer. This was not about one reckless bank or a rogue trader. It was the math of government flows meeting a system stretched to its limit. The result was a cash shortfall big enough to threaten the overnight plumbing that keeps the financial world running. JP Chase, the country's largest bank, didn't just sit on the sidelines as the system's cash cushion thinned. Over the 12 months leading up to the crisis, JP quietly pulled $138 billion out of its reserves at the Federal Reserve, a 35% drop verified in the bank's own regulatory filings. This wasn't a random move. Instead of holding on to cash that earned next to nothing at the Fed, JP Treasury desk put that money to work. About $50 billion went into United States Treasury bonds, and another $30 billion went into mortgage-backed securities. Senior management's line was simple. Cash at the Fed was earning next to nothing, so by swapping it for higher-yielding securities, the bank could boost returns without, on paper, taking on more risk. But this shift had ripple effects. JP Morgan was not just another player in the repo market. By mid-2019, the bank was responsible for 46% of all repo lending among major United States banks. When JP Morgan decided to lock up its cash and bonds and mortgages, that money was no longer available to lend overnight. The rest of Wall Street, already running lean, suddenly felt the absence. Dealers and funds that relied on JP Morgan for short-term liquidity found the tap running dry. The decision, made in boardrooms and treasury meetings, turned a tight market into a powder keg. As the calendar ticked over to September 2019, all it took was a routine tax deadline and a treasury auction to expose just how fragile the system had become. Before sunrise on September 17, 2019, traders watched in disbelief as overnight repo rates exploded. What should have been a routine cost of borrowing, barely above 2%, suddenly rocketed to as high as 10% in some deals. The official SOFR reading for the day was 5.25%, more than double the norm. Across Wall Street, phones lit up. Money market funds and banks, usually flush with cash, began hoarding every dollar. The spread between repo rates and the Federal Reserve's target soared to 300 basis points, 30 times what anyone considered normal. Desks that had never worried about funding were now desperate for liquidity, and deals that always closed in seconds stalled as lenders pulled back. By 9 a.m., the sense of panic reached the New York Fed's trading desk. Within minutes, officials announced an emergency operation, offering up to $75 billion in overnight loans, available on the spot to any eligible bank or dealer that needed cash. This was the first such move since the 2008 crisis. The message was clear: if the market would not lend, the Fed would. The effect was immediate. Rates began to settle, but the shock lingered. For a few hours, the most basic function of Wall Street, the ability to trade cash for treasuries overnight, had broken. The Fed had stepped in to patch the hole, but nobody knew if the fix would last. The rescue didn't stop after one frantic morning. Each day, the Federal Reserve pumped billions more into the repo market, offering overnight loans to banks and dealers on a scale not seen since the last financial crisis. What started as a single emergency operation turned into a daily routine, with the Federal Reserve balance sheet swelling as it funneled cash into Wall Street. By January 2020, the total amount loaned through these operations had crossed $500 billion. The numbers in the Federal Reserve weekly H41 reports told the story. Outstanding repo loans climbed, fell, then spiked again, with hundreds of billions on the line at any given moment. The so-called temporary fix became a permanent feature, as the Fed's intervention grew from a one-off patch to a central pillar holding up the entire system. On October 11, 2019, the Federal Reserve announced a new plan. It would begin buying $60 billion in Treasury bills every month. Officials insisted this was not quantitative easing, it was a technical move to restore stability and keep the gears of finance turning. Yet the scale was unmistakable. The Federal Reserve's balance sheet swelled as it snapped up Treasury bills, pushing reserves back toward early September levels. The purchases did not stop at the end of the year. Even as headlines shifted to the pandemic, the Fed kept buying. The program continued through June 2020, quietly injecting cash long after the initial panic faded. Only in January 2021 did the facility finally close. By then, the emergency had blended into the background, and the line between short-term rescue and permanent support had all but disappeared. Today, the Fed faces soaring Treasury issuance and shrinking reserves once again. The pipes beneath our economy remain fragile, still needing emergency cash when stress hits. Systemic risk did not vanish after 2019, it just faded from the headlines. The next crisis will not wait for a convenient cover story.